Okay, welcome to today's lecture on quantitative risk management. And last week we talked a little bit about backtesting. We've talked already about risk forecasting, but in this chapter 7 we'll talk in more detail about backtesting, and we'll concentrate on one practical example for risk forecasting. We'll start with forecasting and then go into more detail with backtesting. So we have seen many quantitative models by now, conditional, unconditional ones, for the modeling of losses. By now you should have a good understanding on how quantitative modeling in the context of risk management works. You concentrate on risk factors. First of all, you try to identify those risk factors that drive financial losses. You come up with a model, which we then call risk mapping, for those risk factors that drive financial losses. And you then model those financial losses using a statistical distribution, a statistical model. Whether it's time varying, you get a conditional model, or time constant, you get an unconditional model. And then that is your risk model that you're using to forecast risk. Now, one important part of this risk management project we've talked a little bit about in this lecture, but more about in the financial risk management class, is controlling. That is, reviewing risk models that you've used and the calculated and forecasted risk estimates. And you should do this not only once after installing a model, for example, but you should do this regularly. And this is what back and stress tests do. That's exactly their purpose. They validate risk estimates on the basis of historical data, and they have the aim of model improvement. So what is risk forecasting? Let's go one step back even further. Forecasting, in contrast to estimation, is what? Imagine we have this amount of data available, and we're using this data to estimate our model. We get our parameters, we get maybe rho, we get lambda, we get a parameter alpha, and these are the parameters for our data in this period. If we then use these estimates for our model parameters, or our model in general, and we make forecasts, say, let me use this, like this, then these are called forecasts, in German Prognosewerte, Prognosen. What is the difference between an estimate and a forecast? An estimate is using available data to estimate the model on this period for which we have available data. A forecast is using historical data, estimating the model parameters, and to forecast days into the future for which we don't have historical data. So this is in sample and out of sample, actually in sample estimation and out of sample forecasting. We have our sample, which is given here in red, and we are using in sample data for in sample parameter estimation. And then we use these model parameters and we simply continue on this line indicated by the model, and we get our out of sample forecast. Why out of sample? Because these points are lying outside of our available sample, which is this data. Now, backtesting is often understood as the application of historical data to a risk model with the aim of checking the validity of the estimated risk measures, risk ratios, risk values. Now, from a statistical point of view, backtesting is nothing more than a verification of the model fit, of the quality of a model. And then you can do two things. First of all, you can check the in-sample fit, and second, the out-of-sample fit. Now, let's make another example for this. Let's assume we have this timeline, and this is the true data. This is the true data. Now we estimate a model. Which looks like this. And we would see this model estimation has relatively good in-sample fit. We have the data available. We estimate the model based on the available historical data. And we can see that in-sample, based on the data we have available, the model has a good in-sample fit. It has a high quality. Now what we can do next is we can, let's take it red, we can forecast those points based on our model. And these red dots, these are our model forecasts. Now, based on the data we have right now, we cannot check the out-of-sample forecast. But let's assume this here is 2012, and I have to write it here, and this here is 2013. Well, we are in 2020, so we have this data available, even though we only used the data until 2012 for model estimation. So we play a little bit dumb. We say we are going back to 2012, and we are only using the data, let's say, from 2000 to 2012 to fit our model. But in our back head, we know, in the back of our head, we know, well, we have data available for 2013. So we do our model forecasts, and then we compare those model forecasts with the actual data. It could look like this. Something like this. Actually, I switched now the colors. Actually, the black line was supposed to be the forecasts and the red line were the actual data. So let's say, okay, black line and red line. Let's just say that the black line is actual data and the red line is estimates forecasts. Okay. Now what we can see is in sample, if we stop here, the model has a relatively good in-sample fit. The black line is close to the red line, but as you can see, the model forecast, the red points, suggests something that looks like this. And as you can see here, the actual data differs quite a lot from what we forecasted using our model. And this is indicative of a bad out-of-sample forecasting fit. This the out-of-sample fit is rather bad. So that's the general idea of checking the in-sample and out-of-sample fit of a model in statistics. You take the data and sometimes you only use a fraction of the data as an in-sample and you keep another set of data that is more current you keep a more current part of the data of your sample back, and you keep it as an out of sample. And then you can check whether you are actually, whether the model is actually able to forecast into the future. And this is in sample and out of sample fit. Now the estimate, underestimation, we understand the calibration of our model. Usually these will be the model parameters, so that the model describes or explains the data as good as possible, as well as possible. So an example is we have an hypothesis. The age of students in the lecture hall is normally distributed. We have a normal distribution. Data collection results in a mean of 21.4. Standard deviation is 1.28. Then the estimated model is a normal distribution with these two parameters. Very simple. Now forecasting, as I've shown you, is the updating of the values estimated by the model into the future using the previously estimated parameters, and you simply write it forth into the future. So you simulate a number of random numbers from this normal distribution as a forecast of the age of a new student coming to the lecture hall. A very, maybe a little bit weird example, but that's the idea. You have your model and you're using the estimated model to make a forecast, and then you check it. You check your out of sample fit by checking your model forecast with actual observations in the future. Now the in sample fit or in sample means the data sample used for estimating a model, whereas the out of sample is usually the most recent or more current part of the data, which is not used for the estimation, and it's compared with the prediction values, and you check the validity and the quality of your model in the out of sample. So that's in sample where this out of sample fit. By the way, if your model is not even able to produce a good in sample fit, you shouldn't consider it in risk modeling in the first place. So in sample is a good in sample fit is usually a necessary condition, whereas out of sample fit is a nice to have, but at least you need a good in sample fit. So let's now turn to backtesting. Backtesting is actually checking the out of sample fit of a risk model. So the process of evaluating a risk model by applying the model to historical data and then reviewing the adequacy of that particular model. And for valued risk backtesting, this is very simple. You first estimate usually a parametric valued risk model based on in-sample data. You have a prognosis, you forecast out-of-sample values as a VAR barrier. Then you compare those predicted VAR barriers and the realized actual values, the number of, it's usually not called undershoots, it's the VAR exceedances, or the VAR violations. And then you evaluate the different quality characteristics of VAR forecasts. For example, you have the right number. Is it random over time, etc. So that's backtesting. Now let's make it more specific. The risk manager first selects a period on the basis of which backtesting is to be performed. For example, you could say, I'm using data from 2015 to 2019. Then a relevant historical data set is compiled, maybe the last 500 trading days would be close to 2 years. That is, you take all the values of the risk positions and they should be known. Then the data is divided into a training data set, that's the in sample, and a test data set, the out of sample. For example, you could check the model based on estimations made on the first 300 of the observed trading days, and then the out of sample is the last 200 trading days, 301 to 500. Then the forecast values of the model, they are calculated for each day of the out of sample. They're compared to the actual values of the loss distribution. You know these days because you simply artificially have split up your data sample into in sample and out of sample. And ideally, the model should accurately predict every realized value. That's usually not the case. And it's not realistic. So you check the quality of the risk model by the extent of the discrepancies between the losses and the actual losses, and most notably the VAR violations, the VAR exceedances, the days on which you experience losses that were even larger than the VAR barrier. And based on the results found and the weak points identified, you can then try to correct or improve on your risk model. Now, a regular review of the quantitative risk models used by a bank, by an insurance company, by an industrial company is of course in the best interest of risk managers and the CEO. However, financial institutions like pension funds, insurance companies, banks, they are obliged to regularly check the forecasting quality. And in Germany, this is paragraph 318, sentence 1 of the solvency regulation, Solvabilitätsverordnung, that requires that, this is an English translation, the forecasting quality of a risk model be determined by means of a daily comparison of the potential risk amount determined based on the risk model and the basis of a holding period of 1 working day with a change in value of the individual financial instruments or financial instrument group included in the model calculation. So the regulator, the financial regulator, requires this of any financial institutions under the regulation of the German solvency regulation. Now, what are these quality aspects that you are looking for in a good VAR model? The first one is actually quite simple. It's called unconditional coverage, and it simply looks at how often the realized losses were higher than it were predicted by the VAR model. So you have two unfavorable cases. First of all, basically the number of VAR exceedances can be too high or too low. If the losses exceed the VaR barrier much more often than expected, you have high losses. The risk manager may not have built up enough reserves to do so, to cover those financial losses, and in the end you will suffer in your equity. Second example is, well, let's assume your position looks like this. Those are your actual returns. The easiest way to come up with a VaR model that doesn't show any exceedances is to do this. You're way too conservative, and this means that you also keep too much capital, regulatory capital, as a bank or insurance company, that you keep too much regulatory capital locked up on your balance sheet for this position that is not necessary. You are expecting a huge loss, which will never come. So losses are always lower than predicted. The model is way too conservative, and this is not desired as, for example, the profit margin of an investor would be significantly lower. And again, the important issue here is regulatory capital that is unnecessarily kept for this financial position. Now, the model underestimates these extreme risks and leads to more losses than expected. If there are too few exceedances, the model is considered too conservative and thus too restrictive. So what you are expecting is, the condition that needs to be tested here of unconditional coverage is that the percentage of expected VaR exceedances, should be, maybe not call them shortfalls, but VaR exceedances, this percentage should match the confidence level alpha. And tests for this property are usually called unconditional tests or unconditional coverage tests. Why? Because you're simply interested in the number of exceedances regardless of whether they occur once, or if they occur in two clusters, if they are random over time, and that's why they are called unconditional tests. What is a shortfall? What is an exceedance mathematically? So let ZT be real random variables and VaRT the value at risk at confidence level alpha. Then we define this function HT by the indicator function that ZT, those are the losses, that they are smaller or equal than minus VaR. So this is the shortfall at time t, or the VaR exceedance. And you can also define the hits. That's why it's abbreviated with H. It's the hit indicator as exceeding the VaR limits by the loss. And what is the hypothesis now? The hypothesis for unconditional coverage is that the conditional expected value, the conditional mean of HT minus alpha is 0. That's not Fs, but almost surely. What does this mean? Well, the expected value of H gives you the percentage of VaR exceedances. And then this is simply the expected probability of a divergence between the true hit probability and the confidence level, given all information until point t minus 1, that should be 0. Alternatively, we could also say the expected, conditional expected value of HT should be alpha. It's the same thing, we can also include it here. So there shouldn't be too many, or too few exceedances in comparison to the confidence level alpha. So that's a very simple test. The simplest test is the so-called Kubitz test. Paul Kubitz is a researcher. I think at that time, at least, he was working for the Federal Reserve System. And this is the Kubitz test, most popular test for unconditional coverage. It essentially adds up the shortfalls for the n values to construct a test statistic, Kn. So what you take is, you take this probability, Ht, you subtract alpha, you add it for all those observations, and then you divide it by the square root of n. And this expected value is approximated by a kind of average of the shortfalls. And you look at these shortfalls, at these hits, and it can then be shown that this is the test statistics, and as is tradition in statistics, you construct the test statistics, and to make a decision on your hypothesis testing, you need to know the distribution of Kn, the distribution of the test statistics under H0. And what is true is, under the assumption that the shortfalls are Bernoulli distributed, so that HT is IID Bernoulli distributed, or binomially distributed with 1 and alpha, you can show that actually this converges to a standard normally distributed random variable, and then you can check this hypothesis that the expected shortfall probability is alpha is normally distributed. So the parameter of this risk model is unknown, so you need to estimate the number of exceedances, of course, so it's replaced by an estimate HT. You have to look at the paper and at the specifics of this test to know how to work it. And you can see here Kn, if you adjust it by alpha minus, alpha times 1 minus alpha, and then the negative square root of this, then this converges to a standard normally distributed random variable. So it's a very simple test. That's sufficient to see. Now, this Kubitz test only tests for the correct number of exceedances. Now, in addition to the correct var level or the correct number of exceedances, the var hits should also be random or independent over time. And the required characteristics of independence and compliance with the specified var level, this can also be tested simultaneously, and this is a simultaneous backtest. And a risk model is then rejected if either the number of exceedances is too high or too low, and if something happens like this. Oh, maybe I can use a different form. Let me just see. Yeah, let's use it. If we have var exceedances like this, this is not random over time. This is clustered. This is not nice. So it should rather look like this. So it's random over time. And these two factors can lead to the rejection of the var model. The number is not correctly specified, and it is not random over time. So number of exceedances is not correct, or the exceedances are not random over time. For example, you have these clusters of var exceedances. That's not good. And a test of independence then contradicts the null hypothesis. So you can check the sequence of hits, and it needs to be IID distributed. So it needs to be the same distribution, Bernoulli, over time, and it needs to be independent over time. That's important. So these are then called tests of conditional coverage, not unconditional, but conditional coverage. They are based on the covariances of the hits or shortfalls at different times, and you're looking at the autocovariance function, which is kappa j, the covariance between the hit probability at point t and point t minus j. And consistent estimates of the autocovariance function are given by this very simple estimator for the autocovariance. And then depending on the number of delays you choose and the number of lags, not delays, you consider the test statistics LB, n times n plus 2, the sum of gamma nj, this is the estimator for the autocovariance function, divided by alpha times 1 minus alpha squared. And the sum of these squared autocorrelations, this is the test statistic for this test. For example, you can see this in the paper by Berkowitz, Christoffersen, and Denis Pelletier. Now, there is also a different test out there by Christoffersen and Pelletier from 2004. This is based on the intervals between the var hits. And then we're testing the Markov property we've seen already. For this purpose, the risk manager considers the transition probability. So what is the probability of having a 0 after a 0, of having a hit after a 0, of having no exceedance after having an exceedance, and what is the probability of having 2 exceedances in a row. And then you are looking for these 4 probabilities, you compile a matrix, and then you also perform a likelihood quotient test similar to the Berkowitz, Christopherson, Pelletier test, and to check the quality of the VAR model. And you can then test it using the expected and the empirical transition probabilities. The interesting factor now is that actually regulators, especially here in German BaFin, they don't really care about these sophisticated statistical tests. They usually have a very simple test that is based on the Kubitz test of unconditional coverage. This is an extract from a research paper. You can see here the VAR estimates and the hits this company has taken, actually the stock has taken. You can see the Gauge 1-1, the 1% VAR model here with a fixed estimation window, with a recursive one, with a rolling estimation window, and you can see those different VAR estimates here, and in red with these red lines you see the VAR exceedances. One would consider, actually this model is way too conservative, not surprising, but here you would see, well, it seems to be, at least the VAR exceedances seem to happen randomly over time. And then you have to check the validity, the quality of this VAR model. Okay, so this is the theoretical foundation for backtesting. Now let's next go to the practical example in VAR estimation.